Hey, everybody. Before we jump into today's episode, I just want to point out a few ways in which you can work with us here at How to SaaS. Number one, if you're an investor and you're in the middle of a transaction and you want to figure out what is the marketing potential of the target investment that I'm looking at, you can engage with us in a due diligence engagement where within 2 weeks, we can give you a very clear picture of all the levers within the marketing function of that organization for them to drive more revenue and pipeline for the business while being incredibly efficient. Number two, if you're the founder, CEO, operator, or investor of a company where marketing is just under leveraged and it's seen as a growth lever that requires more investment, we can come in and do a deep dive across 3 to 4 months and analyze all the opportunities within that business on the marketing side by looking at demand gen, paid media, account-based marketing, content marketing, product marketing, SEO, website, and much more, and come back with a set of recommendations and a roadmap for what marketing needs to execute against to drive more enterprise value for that business. And number three, if you're the CEO of a company that doesn't have a CMO right now, or there's a gap in the organization because the VP of marketing or CMO was recently transitioned out, we can come in a fractional CMO capacity and partner with you on that business and lead the internal team and the operational plan so that the marketing function continues to make progress and drive more pipeline and revenue. And we'll also help you hire your next CMO by being part of that hiring process and onboard that new person once they're ready to join the organization so that they get a running start. These three types of engagements are some of the most common ways in which investors, CEOs, and companies work with us. And we have a proven track record of driving a ton of enterprise value and revenue growth across those companies. To learn more, go to www.howtosas.com, where you'll get a lot more information in terms of the types of engagements I've described. And you can see case studies and other examples of the work that we've done, so you have a lot more confidence in partnering with us. And with that said, let's get to the episode. Enjoy the show. Welcome to the Private Equity Value Creation Podcast, where we interview leading investors, operators, bankers, and advisors to help you answer one question: how do we increase the enterprise value of our companies? My name is Shiv, and each episode I will dive deep with a guest to help you become a better value creator and capital allocator. So with that said, let's jump right in and let's get started with today's episode. My guest today is Amanda Good, and she's the head of global value creation at Searchlight Capital. And what I really liked about the conversation with Amanda is that a lot of private equity firms are now trying to build value creation teams, and not all of them have a process and a framework to think about value creation outside of some of the big firms that have extensive ops teams to work with their portfolio companies. And I really liked Amanda's perspective on this and how to build a small but efficient team that can help deals and the deal teams as they're making investments, and also help in the first 100 days and to drive enterprise value post-close in all areas, especially on the people side. And Amanda had a lot of great perspectives on how to build out executive teams, how to layer in different types of human resources and capital and different executives that can actually help you talent inside the organizations and integrate teams together and find a lot of value creation opportunities. So I think there's a lot to take away from it, especially as you're thinking about your own firm and how to build out your own value creation team. So with that said, I'll leave you to it. Enjoy the episode. All right, Amanda, welcome to the show. How's it going?
Yeah, very well. Nice to see you.
Yeah, excited to have you on. So why don't we start with your background and Searchlight, and then let's go from there.
Absolutely. So I guess I'm one of those rare people that have spent a career in value creation in private equity, almost 25 years. Started that at Bain & Company in very early 2000. And from there, spent about 15 years traveling with Bain across a couple of continents and working with all different kinds of private equity funds, different sizes, different industries, different investing strategies. Then went on to one of my favorite clients at the time, HG Capital in London, mostly enterprise software, B2B services investor. And there helped to really build out the portfolio value creation team and spent the better part of 7 years there in London. And then recently have now been about 5 years with Searchlight Capital, both on the London side of the Atlantic and now in New York, leading our value creation. Searchlight, mid-market investor. We invest up and down the capital structure. So not only direct for control buyouts, but we do credit positions as well, and really take on multiple different parts of structuring our deals. We're currently investing about a $3.5 billion fund. We're on our fourth fund. Searchlight's a 15-year-old institution now. And we really started in the world of TMT, telecoms, media, and have evolved into all types of services, mostly B2B, more recurring type services businesses.
Awesome. Yeah, and by the way, HG is one of our closest partners, so what a
It's
small
great.
world.
Yeah.
Tell me a little bit more of the value creation side because it means so many different things and in different firms. So how do you guys look at value creation inside Searchlight? What are some of the key areas that you're focusing on?
Yeah, I guess the first thing I would say is, the firm's been around 15 years. I've been the first official hire in value creation 5 years ago, but there were 10 years in there where Searchlight, really had some very successful investments and some great funds. And that's because for us, value creation is a culture and it's a way of working. It's not necessarily a function that sits off to the side. And so, when we're talking about what we do at Searchlight and what kind of deals we look at, you'll always hear us talking about what's the value creation thesis. And because we are often investing in businesses at the lower ends of valuations, sometimes 6, 7, 8 times EBITDA businesses, there's always opportunity in these businesses to take a much more maturity view of it. How can we take this business and mature what is a good business, move it towards great? We're not a great to excellent type investor. We are very much a good to great investor. And so, we always see multiple levers for value creation. That could be operational, it could be strategic, it could be M&A, but we are never looking at an investment and saying we're going to back the management team with exactly what their investment, strategy is and exactly how they see it. We really do try to bring some differentiated ideas, some connections, some out of the box thinking. And so for us, value creation is how we lift the multiples on these businesses and how we really drive above market growth.
Yeah, and given your size and kind of how you look at these companies, how are you doing that, especially in the first 100 days? Talk to me about the plan and how you kind of make that a reality.
Yeah, the plan is everything for us. And I would say that's kind of what we do specialize in, within our value creation effort is making sure that there's a plan that has a couple of elements to it. The first one is alignment. And so you can have a lot of different plans. You can have an IM, you can have a management plan, you might have a base case within our fund. You might have a different shareholder in there that has a different idea for it. Trying to understand exactly what the one version of the 3 to 5 year plan looks like often takes a lot of massaging and a lot of meetings and facilitation to figure out which way are we going to really be going? Are we going to break into that new market? Are we going to try out this new idea? Are we going to stick to our knitting? We go through a lot of incarnations until we have one version of that ambition and financial plan. And then
Yeah.
underneath all of that, we make sure that, the priorities to get there are exceptionally clear. And when I say that, it means, there's possibly 3, 4, 5, 6 initiatives that we're trying to drive in our companies. And underneath all of that is all of the activity that has to happen over the next week, month, year. What resources are required? What data are we going to look at to track them? And almost most importantly, who in the management team is responsible for driving those different initiatives? And do they have the capabilities? Do they have the background? And do they have the authority to really, drive all those initiatives successfully? So for us, that's the combination of the plan as we all describe it generically.
And how do you figure out though that short list? Because I think companies are often drowning in opportunity, right? And there's a ton of different value creation things that you can do pricing initiatives, sales efficiency, marketing efforts, product roadmap items. So like M&A obviously is a common area. So how are you prioritizing against all of these different initiatives? And then how are you determining the amount of resourcing or effort you're putting behind each so that you're not caught up in almost distracting the business with too many
Right.
things?
Right. Yeah. This is something I learned really well at HG because at HG, we were buying companies on the more expensive end. And sometimes we had to buy into our multiples quite quickly. And in order to do that, you had to run fast in the first year and you had to find those accelerating initiatives that were going to drive, organic growth. And that was really the only way to sort of walk into some, forward leaning multiples, which is what we often did at HG. So we've brought that to Searchlight. And when you ask about how we prioritize it, we make sure there's a nice combination of early accelerators, different initiatives that are going to get out of the gate quickly. And you're right, you called out some of the main ones: pricing, sometimes cost optimization, always something around Salesforce and funnels and management and conversion. So we will pull a bunch of those levers in the first year, almost regardless of what the company's doing. And that's kind of our B2B heritage. And then there's a series of medium to longer term initiatives. And, we make sure that there's a balance of those near term, medium term, and then longer term initiatives. And every company has a slightly different shape. But it's really important, I think, that the priority list has some of those first year, get out of the gates fast type of priorities.
Yeah, and I guess there's a balance, right? Because some of those initiatives need to be implemented in the first 100 days so that you can capture value in that first year. And then some initiatives take time to implement. So how do you balance resources between those two? Because and the reason I ask this is because in a lot of cases, we're brought into engagements, or like a firm like HG or other PE firms will ping us on the marketing side. And then we come into these meetings and there are all kinds of initiatives going on, and then there's still a limited executive team, and they're responsible for kind of doing all of it. So how do you balance that to make sure that the team actually has the bandwidth to make all of this a reality?
Yeah, I'm going to plug for another advisor out there. The idea of talent to value. It's a sort of Sandy Ogg framework, which I absolutely love, because what it does is it takes all of your value initiatives, and then it obviously looks at all the people responsible underneath it. But then you take that and you flip it the other way around. And so you've got initiatives with people, but then you see that suddenly John's name is written 7 times across the page, across multiple initiatives. And then you look at John's priorities, and suddenly you stack them all up against each other. And no human is going to be able to sort of achieve all of those, what we call jobs to be done. And if you look at all the jobs to be done that you've given a specific individual in the company, you then quickly find those resource constraints. And, we facilitate workshops where we'll hand John the entire list of initiatives and say, John, how achievable is this in the first year? And you can watch and, witness the reactions of these individuals. And you start to realize all of the holes that you have to plug if you really want to get all those initiatives done. But this idea of not just looking at the head of sales as an individual, but looking at all of the people that are required and looking at all of the initiatives and stacking up the cards that they have on their plate to get done, it starts to create a really different view of the world. And our CEOs, have loved that sort of framework to think about things. It really breaks things into a much more personal, can they achieve it sort of dialogue.
Yeah, and I've seen this inside companies where like 1 or 2 people will be kind of like these linchpin folks inside the organization, and then everybody is kind of like a supporting cast member to those linchpins, and nothing's going to get done unless it moves through those individuals. So talk about the people side, because I'm imagining that that's the case in a lot of your companies. So how do you transform that to make the value creation plan a reality?
Well, I think there's always room for outside help in almost any company as well. And so when you find those bottleneck people, there's almost always an opportunity to enhance. And, I'll give an example. I feel like our poor finance teams, no matter what the initiative is, we're trying to put in a data warehouse, or we're trying to do a new flip of our CRM. Somehow it always comes back to a couple people in FP&A or finance. And so, we've tried to develop deep standing partnerships with, whether it be extra finance support, extra sales support, sales operations is a big area, extra data support. We have a lot of, data capability providers as well. And so trying to find, the right partners to use repeatably is kind of step 1 in that organization. And step 2 clearly is enhancing and growing the team. Mm-hmm. So, making sure that you can up tier a lot of the folks in the organization. So if there really are those bottlenecks, can they step up a level and get people underneath them to do their jobs? But that's a journey we go on over the first, say, 12 to 18 months to figure out, who needs more support. And it's one of those things that we're happy to do, because we're always trying to find ways to, again, create more value in these companies. And part of that is you have to enhance and build the team up.
Right. Yeah. I can totally see that. Like the leveling up from the internal team and itself is super important. At the same time, sometimes I find that when we come into these companies, people are in the wrong seats. Do you see that
Yes.
often, and kind of how do you handle that?
Yes. I think that the first place that comes to is CEO awareness and trying to make sure that we have a relationship with our chief executives where they understand that we really want to partner with them as they explore, the team's full capabilities. What is the potential truly of this team that we're working with? And, our very best CEOs are the ones that say, okay, Sally was great to get us from here to there, but she's not the right person to get from the next spot we're trying to go to. And so we do have tools for this as well. I mean, this is all part of the value creation approach. So we have assessment tools, we have capability tools. One of the easiest, most simple things to think about is people's motivation and ambition. Do they want to do the job?
Mm-hmm.
And so we use Hogan as another tool just to say what really gives this person energy and what kind of skills do they come to work with every day. And if people are very operational and suddenly you're asking them to do something much more strategic, it comes out pretty clearly in these people's own sort of assessment of themselves. And so depending again how forward thinking the CEO is, you might need to give them more frameworks and tools. But oftentimes we just do the simple quarterly talent review, the 9-box model, where you go through all of the people and you say, what's their potential? Where are they performing today?
Right. And how often would you say, like, leveling up the particular seat and saying, okay, like we have some internal talent, but where we need to go to, we need an entirely different level or capability of an executive in that seat?
I can't think of a single company in the 5 years that we have entered and exited with the same management team fully, where, the top 3 or 4 people are still the same top 3 or 4 people. So I would say in 100% of our situations, we are up leveling certain roles. And I think like many other PE funds, probably the most common of that is the CFO. Depending whether it is a secondary or tertiary private equity buyout, oftentimes you have CFOs that have not yet experienced what we would consider to be a little bit of a higher performance environment than, say, a privately held non-private equity backed company where our timelines, our debt levels, our covenant needs, all of those things around our capital structure, the M&A that we put onto these companies, are quite as fast and furious as someone like Searchlight would demand. And so I would say that role gets, probably up leveled about half of the time. Another common one is we very often try to put a proper strategic CHRO into the business. We find there's incredible leverage for our chief executives when we can put a CHRO next to them to try and really take on that kind of talent planning, workforce planning, recruiting, just again, performance management in the business. So I would say a lot of the searches I've supported lately across our teams have been around that CHRO.
Is there a certain size at which that becomes important? Because I'm thinking about larger companies or clients that we have where I can see a need for that. But let's say you're sub 50 million, it may not be the most immediate hire. Like, is there a stage at which you think it's more applicable?
I sort of start with how many hires we have to make every year for our growth plan and
Yeah.
how much M&A are we doing. And so, we have a businesses and industrial services, which, we're hiring significant amount of local labor to help in machine repair or warehouse distribution, and trying to keep that workforce full is our biggest constraint to driving value in those companies, making sure that we've got the headcount in those businesses to do so. So, having someone strategic to think about how do we do, local hiring in all of these different markets we're in. And then on M&A, as we're consistently throwing new teams at our company, oftentimes our C-suite doesn't have the bandwidth to go and evaluate all of the individuals that we're acquiring. And so having a CHRO kind of put systematic frameworks in to drive that M&A valuation is often another trigger for that. So I would say somewhat less size related, more just really how critical is the workforce specifically, to the value creation plan.
Yeah, I think that's a great point on integrations. I guess when there's overlapping roles, integration opportunities in different areas of expertise or creating a center of expertise for the business, HR can be a significant value driver on that side. So yeah, you were going to jump in.
Oh no, I would say that oftentimes we're thinking about, again, going from good to great and trying to make exceptional workplaces. And we don't take that lightly. It's actually an incredibly important attribute of what we do. I really believe in the statistics around the success of companies that can drive human productivity at a faster rate. And I think there's some studies out there that show that less than 50% of most workforces are considered to be actively engaged in their job day to day, which means they come to work, they know the jobs that are required to be doing, they do them with, their best intentions, they complete as much as they can. Oftentimes it's no fault of the employee, but often the jobs are overlapping or there's blockages in the system. They haven't gotten what they needed from somebody else in the organization. And so trying to increase the productivity of, all of our workforces, I just believe drives, tremendous value across the business. It can't be kind of overstated.
Yeah, totally. I think that's just so important. As you're kind of investing more on the people side, and culture is a great area, but just even executives, it ends up ramping up investment on the human capital side of the business. How do you balance that with the financial objectives or covenants or EBITDA targets that you want to hit?
Well, listen, you're hitting on one of the important topics now, which is automation, right? And driving more productivity with the same amount of resources. So that's one of the things that we're most excited about, in a fully AI world, is that, we can keep the same workforce, or again, give those folks in our companies higher level jobs while trying to maintain, the productivity and the automation needs to happen underneath them in order to do so. And so certainly, that's one thing we're looking at in all of our companies is how do we help these individuals to take on larger tasks and more work, without trying to continually increase the overall headcount.
Yeah, I guess, we've seen some companies kind of go all the way. Like in Klarna got rid of a bunch of their support staff and then kind of rehired them back because they felt like AI wasn't ready. First, they thought it was. And so I guess there's that risk as well. So when you think about AI and finding efficiency, especially on the human capital side, where are you seeing some of the biggest opportunity areas?
Finance has been a really interesting one for us. We've managed to really look at all of the manual tasks around collections, working capital, invoicing, all of those very more manual tasks. And I feel like AI has given us a super boost in trying to take some of those tasks out of the hands of people that are quite honestly frustrated with doing them anyway and would rather be doing different tasks. So I would say, our earliest quick wins have probably been around those finance teams. And then secondarily, I would say not so much headcount savings, but productivity lifts for sure on sales. And so, whether we're using tools for call recording, which are predicting, what word choices are more or less effective, we're able to, get more sort of bang for the buck out of sales calls and sales motions and marketing efforts, due to some really interesting kind of AI tools.
Yeah. And beyond AI, when you think about just efficiency in general and meeting financial expectations, because all of these transformational things are happening at the same time, right? There's a value creation plan, there's changes to the team, there's integration opportunities, there's M&A, there's AI. Like, how are you thinking about hitting those financial numbers? Because that is obviously what's the underlying item inside the investment thesis to
Right.
make the investment actually worthwhile.
One of my favorite topics, because I try to avoid looking at the financial results as much as possible. And what I mean by that, sort of tongue in cheek, our my colleagues on the pure investing side are looking at that, sort of results all the time. I have a almost religious excitement about operational KPIs. And so when you're talking about efficiency and the leading indicators that are going to produce those financial results that you'd like to see, whether it's, orders per salesperson, calls per salesperson, different funnel ratios, throughput in our factories, the KPIs that we need to be watching most aggressively and most often are those operational ones. And so, we have a small data team, and we have, I guess I said, a lot of outsourced data support for our companies, because we want to make sure that we've got real-time dashboarding around those operational metrics, so that most importantly, the management team, but also our team, can see before it happens that we might have, a financial result coming out next month that was suboptimal, whether it be, revenue, cost, et cetera. But it's a journey. Some companies we invest in even struggle to tell us the head count in the company
Mhm.
overall. They have so many subsidiaries or whatever it is. Just how many active employees do we have at the company is a really basic example of something that's going to be driving our, our margin in these businesses. And sometimes the hiring of individuals is not centrally controlled, and so their local teams are out there hiring, and suddenly costs go up in Cleveland, and we're kind of surprised why. Well, we weren't watching even headcount hiring. So again, some of the companies we buy are in those positions where just some simple operational KPI reporting is a great way to make sure that we're helping to control what the output is, which is really the financial results.
And how important is that as you're looking at, because bringing it a little bit full circle, as you're thinking about the plan in the first 100 days, along with the team and organizational transformations, like how closely are you tying that together through to, okay, this is going to be the impact of these initiatives on our EBITDA over the next few years? And also, the process improvements that we need to make, or infrastructure improvements we need to make to even enable that kind of thinking, because maybe the company's not even looking at the data.
Yeah. Yeah. So I always joke one of my love languages is a really good EBITDA bridge. So, starting from investing EBITDA to our exit EBITDA. And if you go through, all of those initiatives, again, we start that, as you said, in the first 100 days. What is our focus? Getting through every initiative tied to a financial EBITDA number is critically important to us. And so if you were to see, and we do this in every control investment, if you were to see our investment thesis and what we start to build in the first 100 days, you can see international expansion is going to provide us 8 million of EBITDA. Moving that manufacturing center from here to offshore is going to produce 4 million in EBITDA. And so as we were talking about how many priorities are on the page, part of the reason that we can more easily prioritize them is because we can see the actual real EBITDA impact. And at the end of that EBITDA bridge is always an offsetting, negative EBITDA driver, which is all the operational costs that we need to put into the business. So, a series of positives brought down by a series of, let's call it IT investments or people investments, infrastructure investments, whatever they are. But when we do our 100-day planning, we try to plan all of that through with management teams. So we're critically clear how we get from starting EBITDA to exit EBITDA, and all the steps and the waterfall from here to there.
What type of time horizon do you look at for that type of a plan? Because some investments take time to realize, right?
Yes.
And one of the things that I've seen inside companies is, especially that are being acquired or have just been acquired, there's a lack of patience because you need to get to outcomes as quickly as possible. And some initiatives take more time than that. So how are you looking at those initiatives and making sure, like, okay, we make an investment today, maybe it requires a key hire, that person needs 3 months to onboard, and then there's time to impact, like for ramp up and all of that. So how do you look at that overall?
In the majority of our investments, I have, patience only to a 3-year horizon. And so we will try to drive a 3-year sort of view. Of course, 5 years, the standard sort of, private equity. But if you're 3 years in and you haven't gotten yourself well on the way towards a 2x, it's going to take a Herculean J curve at the end. So we usually do 3 years. I will say we also replan the plan every year. So we have a strategic planning process where we revisit that. The exception is, and that's what makes, I think, Searchlight sort of unique and interesting, is we do have a DNA towards the longer term sort of telecommunications and infrastructure type investments as well. And so some of our most successful investments have been, sort of longer term, rolling out fiber, for example, to rural locations. And obviously that's not something you can drive any faster than humans can produce that. And so those have had a longer and more steady return profile where you really see the fruits of your labor in years kind of 4 and 5. But that would be kind of slightly more the majority, but certainly where our core DNA came from was a lot of our telecoms and some of the more infrastructure methods.
How are you tying accountability to that? Oh, because 3 years, I agree, is completely a fair amount of time, but there needs to be accountability along the way where there's leading indicators that you're looking at and key people are in charge of specific areas of the business. So how are you tying that together?
Big believer in annual performance reviews for individuals. So, we subscribe to the OKR approach, where everyone has those key jobs and their the indicators of what they're supposed to achieve. And then again, the role of a CEO or CHRO really driving end of the year annual review processes. It's like any good business. If you want to measure it, then you can actually manage it. And so trying to link people to outcomes and those key result indicators are something that we try to instill in all of our companies.
Yeah, that's great. What do you? How quickly are you to? Let's say you've identified certain initiatives in your value creation plan, and let's say one of them is not working, or at least doesn't seem to be working 6 months in, which is totally normal. How quick are you to pull the plug on some of those types of initiatives?
Well, I think it's the question between the who and the what. Is the initiative the wrong initiative, or is the team behind it struggling? And listen, our markets move. I mean, this is a world of incredible volatility, and our competitors move fast. So sometimes best laid plans to try a new product or a new feature, or something that's a little bit out of the box. Well, maybe a competitor beat us to it. That's also very real. So in situations like that, that's more the what is the problem, and maybe we do need to pull back on that initiative. But I can give multiple examples of times where the initiative was still the best laid plan, but the team really oftentimes didn't know how to get their hands fully around it. And sometimes that's capability, and sometimes that's how much resource we talked about already. So I would say we are patient, but we are fairly quick to swap out again, different teams or situations where we think the initiative is absolutely the right one for the value creation plan, but potentially the team that we have behind it.
Yeah, that's great. Now, as we're coming up on time here, there are tons of PE firms that look at value creation but don't have the kind of team that you have over at Searchlight. Any advice for firms like that are thinking about building their own internal practice?
I would say start small. I mean, our headcount on the books at Searchlight is 5 of us. We're a small, I guess, but mighty organization against over 100 employees at Searchlight. So I think it's a great way to sort of come towards the end, because it's where I started. It really becomes about a capability. And so if you're gonna hire value creation, it absolutely needs to have a seat at the table. It needs to be an experienced team that's very used to private equity. Quite honestly, this isn't something that consulting teaches you all the skills for. It takes a while to think like an investor. And so I think it's about, again, trying to make sure you hire the right folks into your team that are going to have a voice at the table, that the firm genuinely believes are going to drive investment returns. But I think it's about the right folks rather than an army. I don't think the approach of large value creation teams, which works for some funds, is really the way for the majority of the funds. I think for the large majority of PE funds, you can be incredibly effective with, say, 3 to 5 individuals, and then a whole web of suppliers and advisors and outsourced partnerships.
Yeah. Talk about that a little bit more, is because we've seen that as well, where you have Insight and Vista and some of these firms that have large value creation teams, but most of our partners have maybe 1 or 2 operating partners inside. But even then, like, they haven't figured out the system to build a value creation team. So talk about how your team is structured and how kind of you work with the portfolio companies to give them as much value as possible, and how you're leveraging outside resources to find scale.
Yeah, I would say the main role of everyone on my team, with the exception of one, so there's 4 of us, that I would consider all to be architects or quarterbacks, however you want to think of us. But we are very much, alongside of the chief executive, driving, building, scaffolding the entire value creation plan in the beginning. And that works for us because we do about 4 control deals a year. And so if you think about 4 control deals on both sides of the Atlantic, so that's 2 and 2, or maybe 3 and 1 in a given year, and there's 4 of us, we can really give very dedicated attention to those new deals. And so I think that ratio of sort of 1 to 2 new deals a year per experienced executive in value creation is the right one. And, spending a significant amount of our time trying to get those plans built and then monitoring them in the first year is the way we mostly spend our time. Now, the way we keep that small as well is that we all have our spikes. And so each of us comes from a slightly different background. Obviously, coming from HG, I have more of the growth, sales, marketing mindset. So I know how to do more of the high growth. My colleague in London comes more from the turnaround side. And so his background is very much about trying to deal with cost optimization. And so we can lean on each other well. And then, we have folks with more role in procurement or in areas like finance. And so we all sort of keep our different spikes going, but we can all play the generalist. With the exception of one, as I said earlier, data is truly a must-have in any value creation. Data and technology, having an in-house person that can take management teams on the journey. So there's no friction. You don't have to say, oh, go talk to our friends at this partner or that partner. No, this person is free. They're Searchlight ready. They're on the plane. They're probably there in diligence, helping to create a vision around what data can do for these companies. And that individual on our team and some of the contractors that support him are truly specialists and kind of world-class at enterprise data reporting and increasingly AI.
Yeah. That's fantastic advice. And I think actually even a lot of PE firms that are thinking about this should be thinking about their value creation teams in this way. So appreciate you sharing that. Amanda, as we're wrapping up, like what is the best way people that are listening can get a hold of you and learn more about Searchlight?
Yeah, I think LinkedIn's always the best. I'm an avid user. Start my day kind of every morning looking at new connections and what's happening on LinkedIn. So I think I'm pretty easy to find there. So anyone that wants to reach out, very happy to. And again, as I said in the beginning, I've spent 25 years thinking about value creation through multiple downturns and recessions and then upticks in the market. So it's certainly something that I enjoy having conversations with, and never stop learning from other folks in the field. So appreciate listening to your podcast and getting to know other people's thoughts. So always excited to share ideas.
Awesome. And with that, Amanda, thanks for coming on and sharing your wisdom. Really grateful because there's a lot of PE firms that I know that are trying to figure out this area and don't have a fully built out value creation team. And I think you shed a lot of light into how you're able to add value at Searchlight and how they can do the same. So appreciate you doing this.
Great. Thanks.
Thanks for listening to today's episode. Before you take off, just a few requests from our side. Number one, if you haven't done so already, please subscribe to the podcast on iTunes or Spotify or YouTube or wherever you go to listen to your podcasts. Number two, if you are in the market for due diligence services, strategy consulting, or fractional CMO services, please get in touch with us at www.hadasas.com. And third, please buy a copy of my new book, Exit Ready Marketing. It covers a ton of concepts that we take our customers through, private equity investors, B2B companies, CEOs, operating partners, and marketers. And there's a ton of great value in there that expands on my previous book, Post-Acquisition Marketing, as well. So with that said, I hope you enjoyed today's content, and we'll see you on the next episode.